Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly Video for the 7th of March here in 2023, and we've got some Fed speak. We, that is Chair Powell, essentially undid the surprise news of Bostic when he said, we're not going to raise rates 50 basis points, we're going to raise them 25 basis points. Chair Powell, essentially in today's congressional testimony, said, we will raise rates as high as we need to raise them to combat inflation. And it's eradicated in one session where the market was a couple of days ago. So that's where we'll pick up the video, and we'll talk about some of the leading things in the stock market. Of course, crude being off 4%. These are headline or big movers. VIX, bond market's actually up. The dollar is up 1%. And the weakest of our sectors is financial. So let's get right into it. What happened recently is that we have, or at least the general market consensus, is that inflation is over. Don't worry about it. It's all okay. And that's in part led to the rally of this October, September, and all through January and the peak to February, where everything was okay. But on the flip side, it's not okay. The data have been coming out recently from the CPI to other inflationary measures or economic variables that inflation actually is rising. It's here to stay, and it's not going away. So in that context, the Fed has had to backpedal and backtrack, and they will be most likely raising rates a little bit higher than the market could be comfortable with, or at least people were forecasting and expecting just a few weeks ago. So we had the market down, but those hopes were dashed by, again, a statement from Bostic, one of the Fed governors, that said, I know, I see the inflation. We all see the inflation, but don't you worry. The Fed's going to raise rates a quarter basis point. Market up. And again, Chair Powell today sent that lower with his comments. So where are we left after this? From the perspective of the heat map here in Thinkorswim, on the S&P 500, just about every stock in today's session. Of course, our advanced decline was down at 442 at the close, but almost every stock, not every stock, but almost every stock was red. Which ones were green, at least in the S&P 100? There are three of them. AMD, Advanced Micro, Costco, and Merck. Otherwise, the stocks are red. So on a day like this, we want to focus not on the greens, but on the reds and which reds were most red. And are there clusters? And the answer is yes. It's financials. Financials in general are off almost 2.5, almost 3%. So 2.5% for the XLF down on today's session. And every sector, with the exception of, and that's just a splitting hair, every sector was down at least 1%. Again, except the staples. But generally speaking, that's what we have in today's market. With the broader market down roughly 1.5%, not a lot of difference between the S&P, Nas, Dow, and the Russell. Now, the one that is of interest, all of them are of interest, but is crude. Let's jump right to it. So equities took the hit with the higher interest rate potential. We'll come to the Fed funds rate and the CME Fed Watch tool in just a moment. But before we get there, let's talk about crude, which had its bearish play down from 80 and 50 cents right there. My target in the game plan was 77.50, and that has been achieved a little ahead of schedule. And that's where the crude market is at the moment. That's trading in a sideways range with roughly 82 and 72, roughly speaking, maybe 74 from the last few months. And it's been a sideways trend where the stock market itself has been a little more bullish, and the bond market has joined the stock market. So we still have potential downside targets in the bond market. That's TLT, ZN, and ZB. So if that is the case, if inflation is bigger and hotter and more higher, coming in hotter than expected, then the Fed will begin or continue raising rates again at a faster clip, faster pace than the market set in motion. That has boosted the dollar. And we have continued, we do and have upside potential targets in that USD or the DXY here in the index, and that's going to about 106, maybe even higher than that. And the big one, because we are talking about yield, is the TNX. So on the flip side of the bond price, the yield, again, that's roughly 4%, not 40%, but 4% in the yield TNX. That's where the target has been and achieved. Now let's talk about why the market is down on Powell's statement. This is our Fed funds rate. We call it it's the CME group. It's your Fed watch tool. So here is why the market was down in large part. What are these numbers? Let's break it down quickly. So on this, the Fed funds rate is whether they're going to raise basis point or raise the Fed funds rate by a quarter basis point or by a full half, 50 basis points, half of an interest rate. That will take us, if we go the 50 route, to the 5% level for the Fed funds rate. That is going to generate headlines if it hasn't already. We're not there. So when markets go through a round number like the 5%, that will generate lots of media attention, and the average person will be seeing that. Of course, us at TheoTrade, we are watching this very closely, but the average person probably isn't. When they hear that the Fed funds rate and the interest rates are cycling above 5%, that could be a game changer, at least in the public. So we'll be watching this. Again, that Fed funds meeting is the 22nd of March. What are these things and what are we paying attention to? Not long ago, the headlines were inflation is not a big deal. We're still going to raise rates, we being the Fed, but not as aggressively. In fact, all the interest rates going forward, don't you worry about it. They're going to be quarter basis point hikes, and we're going to stop. So that's what this percent is here. And not long ago, you can see the tracker from a month ago, a week ago, and a day ago. The general consensus, it was a fait accompli. It was just about 100% that the Fed is not going to raise rates to anything beyond quarter basis point, if that. But that changed again in late February. That 90% came to 75%. And a day ago, again, after a Bostic statement that, hey, guess what? We're going to raise rates by a quarter basis point. Don't worry about it. Chair Powell came out today and said, good statement, but we will take the data into consideration. And there's a really good shot we're going to have to raise higher than that 25. I'm summarizing, but that's the main point. And that collapsed, that number, from 90 to 75 to 70 to 30. And that is, if I could simplify things as quickly as possible, why the stock market was such a sell side or on the sell side activity in today's session. Because the realization is hitting the stock market. Inflation is a problem, and the Fed will have to be a little more aggressive. And aggressive means potentially, at this point, the odds favor it, a 50 basis point hike. So that priced it quickly into the market well in advance of that happening. So we will continue at TheoTrade watching this, the Fed funds rate, of course, the probability tool. It is just a probability tool. But as it gets closer, we'll be carefully noting these numbers and the effect on the stock market. Again, in general, higher rates for at least the last year have meant, and we'll zoom back 1 year to conclude, higher interest rates, or I should say inflation. As inflation has gone up, the Fed funds rate has gone up. And that, to me, makes the most sense. If inflation is a problem, the Federal Reserve will raise rates. And if the Federal Reserve does raise rates, rates go up. And if the inflation goes away, Fed funds rate comes down. That was that. And now we see the inflation coming back. Therefore, interest rates are going up. Take it one step beyond that. And as the Fed funds rate goes up, the bond market goes down. ZN, ZB, and TLT. And to a little bit lesser extent, but nonetheless a significant extent, the stock market, all things being equal, goes down. The most heavily hit are going to be those sectors or stocks with high debt or high interest or things that are affected more by higher interest rates. The Nasdaq was the, I'd say, beneficiary, but the opposite. Nasdaq was the hardest hit market in general, or technology, in 2022. And they did get a recovery just into 2023. But nonetheless, that is what we're watching in the big picture. And of course, that dollar is going to track the yield. If the yields come down, dollar comes down. If the yield starts to go back up, the general thinking is that the dollar goes up with it. So as we go through this week, Weakest stocks in today's session: Wells Fargo, U.S. Bancorp, Bank of New York Mellon, Bank of America, Tesla, and the others, Goldman Sachs. The general consensus is that they were financial stocks took the hardest hit or the heaviest hit of the sell side activity in today's session. That makes sense because financials were in focus, as was the interest rate and a rapid shift toward the sell side activity. As always, be careful and safe. This is Corey Rosen with tonight's Theo video update for March 7th, 2023.